Ladies and gentlemen, good day and welcome to TrustLine Holdings Investor Call for PMS Fund. I now hand the conference over to Mr. Arunagiri, Founder, CEO and Chief Investment Officer.
Thank you. Hi everyone, good afternoon. Welcome to our investor call. Thanks for joining on a weekday. Really appreciate that. As all of you know, we do this call once in every 6 months. These calls give us a forum to share our views on portfolio perspective, portfolio strategy, and portfolio actionables. Also, how the portfolio is shaping up in terms of future outlook. So, in that sense, I always look forward to these calls every time. This is no different. And in terms of structure, it's the usual structure. We'll start with opening commentary to share the market view and portfolio highlights, and then hand over the call for a Q&A. Overall, we would like to wrap up this session in 45 minutes to 1 hour. That's the plan. We would like to spend more time on Q&A, so I'll not take too much time on the opening commentary. At max, about 15-20 minutes on that. So without taking too much time, let me straight jump in. So in terms of market outlook, what I wanted to highlight is, the ongoing dramatic shift in terms of the trend. If you go back and look at, we have been always consistently communicating and highlighting that whenever there is a kind of cool-off in the global AI trade, that particular shift will be very, very positive for India, which is what we have been consistently articulated over the last few months. And whenever that crowded AI trade or AI positioning across the global markets begins to take a pause, India, as being a contra AI trade, would start benefiting. While it is still in early days, the data is increasingly pointing to that direction. So just let me share some data points. Since the peak of AI trade on June 22nd, 2026, which is last month, we have seen dramatic collapse of some of these Asian markets which had been rallying on AI-driven frenzy. Take, for example, Korea. It is down as of yesterday. Today it's a different story, which I'll come to it later. Korea's KOSPI has declined by nearly 38% since 22nd June this year. And Japan's Nikkei is by 14% fall, Taiwan by around 16%, and China's Shanghai Composite suffered close to about 8%. The lone exception in the whole Asian market is Hang Seng, which has moved up by 8%. This is as on yesterday. Of course, there's been a dramatic reversal today in KOSPI, which has moved up by 18%. But no one is sure this kind of volatility is kind of how it's going to sustain. But certainly there's beginning to kind of one feels that there is kind of AI frenzy is taking a pause at least. So whether this trend is likely to sustain, no one will know, but only in hindsight we'll know what kind of trend is going to shape up globally. It's not only the price action, the full story you got to look at. There is another part to it in terms of FI inflows. The most compelling evidence comes from the FI flows. Since 22nd June, FIs have turned net buyers in India. Not dramatic numbers, but with inflows over about $2 billion. This is after a long, long time. We are seeing net inflows of $2 billion. At the same time, markets that were major beneficiaries of AI trade have witnessed sizable outflows. If you take Korea, it's about $25 billion outflows since 22nd June. $30 billion have gone out from Taiwan and over $7 billion from Japan. Such a stark divergence in capital flows is hard to ignore. So taken together, the market performance as well as the flows data provide early evidence that global investors may have started rotating capital away from the crowded AI trade towards relatively underowned markets such as India. But this very early days, we can't be very sure about it. But in many ways, India is increasingly emerging as a natural diversification play in the post-AI trade, if at all it takes a much larger cool-off. The key variable to watch, of course, remains the geopolitical situation in West Asia conflict. A meaningful easing of tensions, we don't know when, would likely to improve global risk appetite and could further accelerate capital flows. For now, this is how the trend is looking. Does this mean there is going to be a breakout in India and market indices? That as we have been articulating for a long time, that it is very, very unlikely that you will see a major breakout in indices. The reasons are very simple. The major cohorts of the index, which is banking as well as IT, which is unlikely to lead to a major breakout. Though IT is seeing a kind of a trading bump because of cooling of AI trade, structural story for IT looks weak, and banking, of course, the results have been good, but given the NIM pressure, though the credit growth outlook is good, the overall, you are very unlikely that one would see a surge in earnings for banks. As a result, it is unlikely to lead any major breakout at the index level. Having said that, given the positive environment because of turnaround in FI flows, if the AI trade takes pause, if the AI trade cools off, then the entire action could shift to broader market in terms of stock-specific actions, which is what we've been witnessing for the last 4 months. That trend might accelerate and gain traction. So, which is what we feel is the overall the market in terms of how the trend is looking. So let's now switch over to the most interesting part of the opening commentary, which is about portfolio highlights. Not many quarters one get to talk about very, very substantial, significant returns in our portfolio strategy. At least last 2-3 years I have been giving this commentary. In none of the quarters we have seen such a stellar performance like what we have seen in the previous quarter. As all of you know, last 2 years has been a kind of a consolidation or range bound kind of performance for our fund, and the portfolio didn't do much. But the key thing which we did in terms of portfolio action, in terms of execution, in a very disciplined manner, whenever there was an opportunity, when there was a fall in the market, when there was a fall in our stock prices, we, in a very religious and disciplined manner, kept adding at those opportunities. So as we would like to highlight, after a sustained period of staying long to our high conviction ideas, despite their underperformance over the last 2 years, and adding meaningfully to those positions at every opportunity during market downturn over the last 4 quarters. It is extremely satisfying to see those convictions being rewarded. Several of our largest positions have now entered a meaningful re-rating phase, driven by a combination of improving business fundamentals as well as significant earning upgrades. We believe that this re-rating cycle is still in early stages and has the potential to gain further traction. As a result, after a gap of nearly 2 years, the fund has once again outperformed the Nifty small cap index by a significant margin. For a long time, I think our performance against small cap index has been some sort of wanting, and that has been one of the key issues with our portfolio strategy. Not anything to do with our stock picks. Fundamentally, our strategy went through kind of underperforming cycle. We are coming out of that. More importantly, the strong quarter has enabled us to recover a substantial part of the relative underperformance accumulated over the past few years. While we have already regained meaningful outperformance over a 2-year period, our 5-year rolling returns continue to trail small cap index in a very, very marginal fashion. We expect this gap too to narrow over the next few quarters as the re-rating in our core holdings continues to unfold. In fact, if the current earning trajectory and valuation normalization sustain, we would not be surprised to see our 5-year performance also move ahead of the benchmark by a meaningful and material margin. There are 2 factors I would like to highlight that has been the real drivers of this quarter's performance. One is the market environment. Market has become, as I said in my market commentary, it has become increasingly stock-specific, bottom-up market. At the index level, you don't see much of an action. It goes up, goes down, but primarily it is in a range. All the actions and attention then shifted to the broader market space where stock-specific individual stocks where there has been earning upgrades, they get rewarded substantially. So this environment has helped our strategy significant manner. Second driver, several of our largest portfolio companies have reported significant earning upgrades and positive business developments, which is what we bought it for. It has only taken a little longer than what we expected, but it's playing out now, validating our original investment thesis. The combination of improving fundamentals and a market willing to recognize those improvements because of the current market environment, which is favorable for individual stocks, has created a very powerful re-rating for our strategy. We have always believed that buying businesses with a significant margin of safety, remaining patient through the period of underperformance, and allowing fundamentals to play out is the most reliable way to long-term value creation. The current quarter in many ways reflects that early rewards of that discipline. We remain optimistic and confident that this trend is likely to gain further momentum. That much is about the overall view on the fund performance. Now coming specific to the return numbers, the fund delivered a return of about 31.79%. This is as on June 30th, and July also is okay. It's staying almost at the same level compared to 24.02% for the Nifty Small Cap 250 Index, resulting in an outperformance of nearly 800 basis points. As to be expected, this sharp improvement had a meaningful spillover effect on our rolling returns as I had highlighted. And we expect if this trend continues for the next 3-4 quarters, our 5-year return as well on a rolling basis, we should see a material outperformance vis-a-vis the benchmark, which we have been missing for the last 3-4 years. So this milestone, of course, is very satisfying. The extended periods of underperformance inevitably test the conviction of our investors, including some of our long-standing supporters, to see the strategy recover and validate the underlying investment process is far more gratifying than the quarterly returns. I sincerely mean this. For us, the restoration of confidence in the investment philosophy is all which matters, is a more meaningful achievement than the numbers alone. So in our assessment, the fund is positioned for a strong rebound for the course of this year, and the current earning trajectory across the portfolio sustains. We believe that the fund has the potential to generate meaningful outperformance. I would like to focus before going into Q&A a little bit on our revamped research process. I just want to highlight this is an opportunity for me to share that how AI is helping our research process. With AI tools, the number of opportunities we can screen and build pipeline and in terms of get the story right is dramatically multiplied over the last 6 months. 2 years back, if we could screen and study ideas about 100 companies in a year, today that has multiplied to about 200 to 300 companies. That's the kind of efficiency has come in terms of ideation process. This is nothing to do with the deep research or deep dive. I'm talking about the ideation process where you get the leads, and in terms of getting the initial study out and then see, decide whether to be this particular position we should keep it for tracking and what exactly we should track. That's what we call as ideation process. That process has been completely strengthened by using AI tools. That's one research area which is going to benefit in terms of how we are going to build our portfolio in future, and you will see that spilling out our performance results in the coming years. The second bigger thing what we have done in terms of deep dive and deep research, we have now tied up with a partner for primary research. And in my view, that is also that is likely to, in my view, I think that is going to go a long way in terms of scaling up our judgment, our competence, our ability to take a fit on any business when it comes to deep dive and deep judgment. So these two are clear, in terms of differentiation which will come into our research process, which will, of course, you will start seeing the results in our portfolio performance in the coming years. So with this opening commentary, I would like to now pass on the floor for Q&A. Thanks a lot for joining this call. Thanks once again.